Hi there, this is Chris from MoneyHub, and this video looks at the March quarter 2025 report from Morningstar for KiwiSaver. So they publish this report every 3 months. It's very, very useful. I highly recommend you going through it. And the purpose of this video is to go through exactly what Morningstar reports, what it all means, how you can interpret it, and then you can use the report yourself to look at what you want to do. Now you can find it linked on the morningstar.com.au site. That's linked down below in this video. And they publish them, as I said, every 3 months. And there's a main KiwiSaver page, which will have all of the historical reports. Let's get straight into it. So what you do is you click on this PDF, and it loads in your browser. And we'll get straight into it. So what they've said is there's $121 billion New Zealand of KiwiSaver money currently in, and that is always compared on the previous quarter. Of course, if markets are rough or there's something unusual happening, that could go down, despite the fact it will be 3 months before. But they just make sort of commentaries along this. So what I would suggest is have a read through. We're going to look more at the tables. But one thing that's really important is ignoring the short term. So there is so much short term reporting in Morningstar with 3 months, 1 year, and arguably even 3 years. But 3 months means very little, long term, of course. So we really focus on looking at 5 or 3, 5, and 10 years. And what you can see is if you go down through this, there's some commentary around New Zealand dollars, everything like that, and looking at the market share of the fund managers. Then we go straight into it. What is interesting is you can always see the highest 3-month performance this quarter, what fund that was, and in this case it was the Super Life Europe. And then you can see the lowest 3 months, which appears to be a very niche kernel fund, Moonshots fund. And then you can see the highest 12-month performance, KiwiSaver fund, which is 26% from Kernel. That's their global infrastructure fund. And then you can see the lowest, which is a Kernel Kensho. I think it's electric vehicle. That is electric vehicle. So there's a niche fund there as well. So that's always interesting just to have a look at. Of course, short term is 3 months and arguably 12 months. It's just good to know what that means there. You can see that there's 21 fund managers which will manage KiwiSaver money. At the same time, there's 309 different funds to choose from. Now this isn't so relevant, but they do talk about some of the default funds here. So you can see the size of them. The aim there is to, for everybody to obviously move out of those eventually. But that's what Morningstar's snapshot really talks about. Let's go straight into the good stuff. I think that's really what we need to be doing. And what really matters. So they've grouped everything by conservative, balanced, everything like that. We're going to go straight down to growth. So there's moderate, and then you've got your balanced. So these are all the funds. And then if we just go into growth, this is where things really get interesting. So what they have there is the 3-month returns, the 1-year returns, the 3-year returns, the 5-year returns, and the 10-year return. So you can see all that. That's always very useful. The more data there is, the higher the sort of validation on the fund. Now, if we go through, let's just have a look at the 3 months just for explaining, because it's kind of easier to read it like this. You can see here that the fund, which in this case lost the least because of the volatile 3 months, was the Milford Active Growth Fund. And the reason that is because it's performed a negative 0.2%. The second one, of course, this is all rounding, was the Invest Now Salt Sustainable Growth Fund. And then you can see number 3 here is the Summer, which is minus -1. So that obviously is worse than minus 0.2. And then all the way down to some of the larger ones, which is the Generate Growth Fund, for example, which in the short term, and I do mean this in a very 3 month sense, has lost 4.3%. Of course, this is only 3 months, so what is really useful to look at is the long term. Now, what's interesting here for the 10-year growth, you can see that belongs to Milford Active Growth, but then one of the largest funds, being the ANZ Growth Fund, though the ASB fund is it's roughly about $1.3 billion larger. You can see here that its 10-year performance has been the 14th, so that's 6% versus that's about growth 6.9 versus Milford's 9.8. This is after taxes and fees. And so that does show you that there is a big difference over the 10 years. If we look at the 1-year return, if we look at the 3-year return, we can see that belongs to the Key Street Growth Fund, followed closely with a 10% return over 3 years, followed by the Milford Active Growth Fund. So that Milford Active Growth, as you can see there, does tend to perform, well, certainly in this case, a 10-year, 5-year, and 3-month number one, and then sort of leading results or 1 year is like placed 9th. But that's just good to be aware of. There's so many other funds, of course. You've got things like Simplicity. So you can see over 5 years, that's placed number 4th for its growth fund. But many people will be with the banks. So you can see the likes of ANZ, and you can also see ASB's fund performance compared to, leading ones. You can see here, for example, the ASB for 5-year has leveled out around 10%, whereas Simplicity, for example, is 10.2%. So that is very, very similar. There's so much to talk about this. I'm going to move on to more aggressive funds, but I think it's really good just to have a look at this and interpret where your fund is, find out what your fund's doing and have a look around and see what other funds are up to as well. Now, if we go straight down to the aggressive, then arguably this is where more and more people are going. Time is short. The best time to grow is yesterday kind of mantras. You can see here that the 5-year return for that belongs to Milford Aggressive with 13.5%. And then in the 3-year term, you can see that is at the Generate Focus Growth. And then for a 1-year return, you've got 9% here. You've got Kernel High Growth. Now that hasn't yet done 3 years. I think it's coming up to 2 in about 6 to 12 months. So that could so that will appear there on the 3-year once those come through. What's interesting is that things do move around, and you may ask, well, will my aggressive fund, if I go with an aggressive fund, will that perform better than a standard growth fund? Well, the answer to that is, let's have a look at like a 5-year return. So the number one return for the aggressive funds was 13.5%, whereas for the 5-year return, it was 11.1%. So 11.2%. So you can see there that there is a bit of advantage, or certainly higher growth from a more aggressive fund in those 5 years per those funds, but it really just comes down to your choice. So these here, just to make it clear, these numbers represent the size of the fund. So, for example, the AMP Aggressive Fund has $909.9 million in it, so almost $1 billion, whereas your BNZ High Growth Fund has $252 million, so about $250 million, and then you can see the large size of this Generate Focus Growth Fund, which is $3.6 billion, and then Milford as well with its aggressive fund. So that's something to just be aware of course, and to interpret them as you need to. And then we can go down and have a look at specific single sector things like cash funds, fixed interest funds, and then international shares funds. There's a lot of Kernel and Invest now in that. Superlife also has the ETFs, which go in, of course, to Superlife and are very popular there as well. Then you've got your Australasian, so you'll find a lot more Superlife in that. And then if you just carry on down for miscellaneous, this is where they group a bit of everything. So you've got like emerging markets, you have socially responsible funds, capital guaranteed funds, all sorts of things. So they have, and then you've got those moonshot funds from Kernel, as well as the electric vehicle ones. Those are very niche, not very popular funds. You can see here that it's $200,000 in one fund and $700,000 in another. So when you see those performances, that isn't really reflective of a significant amount of money moving. It's just that those funds have been offered for some time through Kernel, and people do invest in them. So that's some of the smaller funds that you'll see. Now, for the market share analysis, this is always interesting. Not that it matters for your fund or your scheme, it just shows where all the money is. So the number one size scheme is the ANZ. Their KiwiSaver scheme has about $21.5 billion in it, which is roughly around 20 or so percent, slightly under, around sort of 17, 18%. The second most popular is the ASB. Of course, these are all large banks, hence they've been quite aggressive. Fisher Funds is number 3. That's come from Legacy Fisher being really quite fast to market with KiwiSaver, as well as the fact they bought Kiwi Wealth a few years ago and integrated those funds into Fisher Funds. BT is Westpac, and then the fifth largest is Milford. So none of this really does matter. It's just interesting to see. Some of the smaller schemes, such as Nico AM with its Goals Getter platform, and then you'll see things like Simplicity, which has now become top 10 and clearly growing as well, alongside Kernel, which is around 1/10 the size of the Simplicity, but they have only launched KiwiSaver in the last year or so. Like, you'll also see the Sharesies scheme. So that's where they've launched their funds, not their own funds, but Sharesies wraparound funds. You can see they've got around $283 million there. And it's just worthwhile having a look. So that's another explainer on what that is. Then you'll just have some more commentary and some disclosures, and that's basically it. Now, if you do download this, you may be asked, what kind of investor are you? Are you basically you will put a household investor or a retail investor? That's kind of standard. Just download the report, have a read of it, have a look through. These guides will be updated going forward with regards to the videos. We're going to do it every 3 months now, just because there is some market movement, and it's just good to shine a light on what's happening and anything like that. Now, if there's anything you want me to cover in this video that's not covered, anything around the commentary, do let us know in the comments down below. We're very responsive to these comments because we want the resources to be as comprehensive as possible. Thanks very much, and we will publish the next guide in around 3 months.